Welcome back to This Is Not Financial Advice. Today, I have a very special video for you, which has been a long time in the making. So, today we are going to be taking a look and an overview of my entire investment account from a 60,000 foot level. My portfolios in totality are at $52,493, and the investment portfolios are 2.5 years old. So we're going to be taking a look at each and every buy, hold, and sell decision I've ever made, down to the penny, down to the hundredth of a share. And along the way, I'm going to share 10 tips or tricks or 10 do's and don'ts, things that I would do differently if I was to start again today. And so if you're just getting started in your investment journey, or you're looking at overall portfolio construction theory, you're probably going to be able to take a lot away from this video. So do like the video and subscribe to the channel. And with that being said, we're going to jump right into it. Quick admin note, if the video is fuzzy, click the gear icon in the bottom right. You can turn this up to 1080p. And we're going to be starting on Qualtrim. Disclaimer on Qualtrim. It's a software I pay for looking at my investments. Although I'm not affiliated with Qualtrim, I will leave a link to Qualtrim in the description below. So let's just jump right into it. And we're going to take a look at my total holdings across all of my portfolios. So I have 68 individual securities that I own, a dividend yield of 1.55%, which is slightly higher than the market, an estimated annual dividend income of $815, as well as a total account value of $52,493.92. And so the first thing we're going to be taking a look at here is this pretty little picture, like a rainbow butterfly. And this is just a visualization of all of my investments from that bird's eye view. And so we're going to just go through quickly everything that's to 1%. And then we're going to dive deeper into some of these holdings. But first, I'm going to deliver a first couple of my lessons learned. So my largest individual holding is going to be a Fidelity mutual fund, which is with my 401k. It's the total US stock market. It's at 21%. At 10%, my largest individual stock holding is Amazon. At 3.4% is Winnebago, 2.9% Smith & Wesson, 2.8% Vanguard Small Cap Value. I have that in an individually managed Roth IRA. Google is at 2.8%. Netflix is at 2.4%. Visa is at 2.4%. Vanguard Growth, large cap growth, is at 2.2%. At 2% is Cummins. 2% is Coca-Cola FEMSA, that's Mexican Coke. Apple is at 2%. Williams Sonoma is at 2%. Salesforce is at about 2%. At 1.9% is Intel. 1.9% is Best Buy. 1.7% is Coinbase. 1.6% is Sam Adams. 1.4% is going to be Trulieve Cannabis. 1.4% is Wheaton Precious Metals. 1.3% Walgreens. 1.3% Tesla. 1.3% Turning Point Brands. 1.25% Green Thumb Industries Cannabis. 1.2% is Kroger. 1.2% is Vertex Pharmaceuticals. Just over 1% is Vanguard Healthcare. And then rounding out the holdings just to the 1% and higher is going to be Berkshire Hathaway at 1%, or $520. So this is the overview of my portfolio in a visual sense here on Qualtrim Portfolios. We can take a look at my allocations by sector. And so, I'm just a regular guy. So a lot of the companies that I hold are consumer, both discretionary and staple. And so we can see here that this portfolio has a broad tilt towards consumer, cyclical, and defensive. I do like the healthcare space, so I have a good amount of holdings in that, value by sector of 3,400. Value by holdings and consumer cyclical is 12,000. Consumer defensive is 6,000. And then miscellaneous, technology is at 4,000, and then miscellaneous is at about 17,000. So that's kind of how I'm allocated sector wise. And this is where we can see the total gains and losses for different holdings. So I'm obviously not holding everything equal weight. Just taking a quick look at this, if I was, I would probably be doing better than I am. But we can see my top two highest returning holdings are going to be Facebook as well as Vertex Pharmaceuticals. And my top two biggest decliners are going to be Trulieve as well as Smith & Wesson. And we're going to come back to that in a second. So let's see if we can tie in my first lesson learned. So, yep, perfect timing. Don't run into stocks that are either jackknifing up or going straight down. And so my two biggest decliners, and this was 2.5 years ago, were going to be Trulieve and Smith & Wesson. So I probably put as much as $4,000 when my portfolio was brand new into these stocks, which have taken major declines. And there's going to be potentially a small amount of permanent capital loss. When you go down 60%, you have to come up something like 180% just to get back to even. Although I'm still holding these, number one, because I'm stubborn. Number two, because I believe in them long term. But I guess just an addendum to point number one, which is don't run into stocks at all-time highs when they're going up or going down, is that you can be right about a stock, but you can bet too heavily into it at the wrong price. And it doesn't mean that you were wrong about the investment. It means that you were early. And depending on how right or wrong you were, being early can be the same as being wrong. But we only make money in stocks where we pay for lessons. Never lose anything until you sell. So let's keep it pushing here. And we're going to get over to Google, and we're going to take a look at the holdings overall. So I'm going to show you in a second some areas where I've outperformed the market. I will sort of say this as a note. All that I've ever done in the market is lock in wins. So far I've locked in about $600 of profit on some of my first companies I ever bought, which was during the peak of the pandemic, Home Depot, Casey's General Store, as well as Dollar General. So at one point I had around $6,000 allocated to these stocks. They were my first couple stocks that I owned. I was up to $1,000. It went down. I was at $600 in gains. Sold too early, which is another point we're going to be touching on, but I locked in $600 of profit, which I then rolled into some of these holdings that are down still substantially, including Smith & Wesson, Trulieve, and companies like Amazon, which we're going to talk about their drawdown on that. So over the last 2 years, my total unrealized gains is negative 5%. The market is probably up on average, probably about 12%. So 24% over the last 2.5 years. So I'm lagging, the market by 30%, which looks really bad. And it's not great, but we're going to talk about it. And I'm going to show you an area with some lessons learned that I implemented kind of halfway into the journey, where my largest portfolio is currently outperforming the market to a huge extent. But a couple of bad decisions have really weighed me down. And so I'm hoping that this will be helpful to someone else out there who's looking to get started in investing. I'll remind you to like the video and subscribe to the channel, but let's talk about some of these things. We're going to look at the holdings by largest amount, and I'm going to sort of give a one-liner, as I'd explain to a toddler, about what the investment I have is and why I hold it. So let me start with point number 2. So when I first started, I only wanted to buy individual stocks. They were more exciting, things of that nature. That was a mistake. So lesson number 2 is buy ETFs. And so let's talk about that. So my biggest holding currently is going to be the Fidelity Mutual Fund, which is the total United States stock market. I've got around $11,000 in that. And, I'm up on that position by about 7%. The position is about a year old. So going down the line, Amazon. Okay, Amazon. The future of commerce is digital. That was pulled forward in the pandemic. I rushed into the stock way too high. At one point, I was into the stock and down 40%. And so I held it and I held my nose and I bought more. But I had a lot of concentration in Amazon, which I when you see all those positions that are less than 1%, I felt burnt. So I basically tried to overcompensate by getting extreme diversification because of reasons. And I'm going to tie that back in here in a second. So Amazon, it's online commerce is the future. Amazon also has AWS, which is basically the home for the internet. So if you think people are going to buy things off the internet and the internet's going to be a thing in 30 years, 20 years, I'm going to make a lot of money on Amazon. Have been down 40%, bought it on the dip. It's risen down 16%. Okay, so number 3, when I rolled in my profits from those first 3 companies I mentioned, I did buy Winnebago. This one has not performed as poorly. I've tried to average into it, but I'm down 10% on my third largest holding. So this is kind of weighing on my total, unrealized gains. We're going to go through these here briefly, and I'm going to pause just at a random point to sort of share point number 3. But this is going to go back to point number 1. So Smith and Wesson is a stock. When you look at the chart, it goes up before elections and then down after elections. And so I bought one, not in an election, but during the peak of COVID when there was a huge demand and consumption of firearms. And so I did a valuation on this stock, and I feel as if it's worth, it's trading for about $20 or about $12 a share right now. I feel like it's worth 25, 35, $40. At the time, I thought it was worth more than that, and it's still worth more than where I started in the position. But I rushed into it as it was chasing up because I said, this is what I think the value is. Now it's starting to take off. This must be it. Better get in before I miss out. So FOMO is a thing you want to avoid, but I'm down 48% in this position. Started buying it around maybe $35 and I've averaged down to about $20. So I've been down more than this. It's coming back up in a big way. I'm continuing to average in, but let's keep it pushing here. So VBR is United States stock market small cap value. This is one in a Roth self-directed IRA that I'm using to complement my total US market, which is essentially a large value fund. Vanguard VBR is essentially a US small cap value fund, whereas this top one is a large cap growth fund, if I had misspoken. So this is a newer position. Everything's looking fine there, but there's some concentration. So number 3, I'm just going to describe it now because I think it's important. So if I was to start over today, I would use a core and satellite approach, which is basically something that it's an investment style that I learned from Jake at Dividend Growth Investing. And so I'm just plugging in my computer here. While I'm doing that, you can just take this opportunity to like and subscribe to this channel and video. So core and satellite investing is basically where you might hold one ETF in a given portfolio and then have a separate portfolio potentially of more individual stocks. And so if you're wrong on your individual stocks, you want to have at least some part of your holdings that are in a broad-based diversified ETF. And so when we talk about core and satellite, we're going to sort of see that in practice. And I'm going to show you an example of what I would have done today if I was to, take the $55,000 I've put into the market. If I was to do it all over again today, I'm going to actually show you towards the end of the video what my returns would have looked like. But after having some early wins in the market and then running into other stocks where I had, it was a time of market euphoria. It was a time of market euphoria. And point number 4 is you're not the next Warren Buffett, and neither was I, or am I, or will I be. And so after having these wins in the bull market where everyone's a genius, I took wins from these defensive stocks like Dollar General and Home Depot, where I had, realized $600 of gains, and I put them into stocks that I thought were a lot more undervalued, which included Smith and Wesson and Winnebago, and to a lesser extent, Amazon. But I went into these stocks with high concentration, thinking I'm the next Warren Buffett. That so far has not worked out for me. So what I did at that point is I went ahead and I started opening up multiple other positions of smaller sizing, realizing the mistake that I had, but not still believing in the story of Amazon, Winnebago, and Smith & Wesson, not wanting to get out of those, just knowing that it was going to take some time to come back. And so this is where we get into a part of my portfolio where I've had some better success. So we have a lot of stocks that are in this $1,500 to $1,000 range. And so Google, I own Google because YouTube has more watch hours than any streaming service combined, essentially. And so I'm up. It's about a $1,500 holding. I'm up 8% or that amount of dollars. Netflix, I think they have the best content. Streaming is the future over linear. I'm into that. High conviction hold. Bought it. Went down a lot. I've been down a lot on it. Bought some more. Unlike certain super investors, I had conviction and I held. And now I have a nice unrealized gain of 19% with that amount of gains. Visa. When someone swipes a card anywhere in the world, Visa essentially gets 1%. So essentially a duopoly. And these phrases, duopolies or monopolistic companies, something I take from another great content creator, Joseph Carlson. So Visa is a company that I hold. I got into it before I started following him, but up that amount for that amount of dollars. Vanguard large cap growth. Okay, so my first stocks that I ever bought were back in about 2017 or 2018, where a 401k was set up for me on my behalf at a retailer that I work for. And the guy who came in and sold me the stuff was a real sleazeball. He sold me a bunch of funds with high expense ratios. I had no idea what was going on. After about a year and a half, it was down like 7% when the market was up massively, like 30%. I was like, what the heck? So I took the money and I just put it into a Vanguard large cap growth ETF. Not doing much with that. That's in a retirement account. It's up 13% or that amount of dollars. So Cummins, I'm up 5%. It's around another $1,000 holding. Basically, they make some of the best engines. Along with some of my other holdings, EVs are the future. There might be negative sentiment around traditional gasoline or diesel engines. But Cummins has some military contracts. They have a great balance sheet. And, I think they'll be continuing to sell commercial or agricultural diesel vehicles as well as military engines and generators. And then these diesel trucks into the emerging markets for decades to come. And so I think it's a better company than the market gives you value for. I've got a buy order in on it now. That's Cummins. So, number 5 takeaway is you can still beat the market even though you're not the next Warren Buffett. And when I show you what I would have done differently, I'm going to explain to you some of the philosophies from investors like Peter Lynch as well as Ray Dalio. Not to mention Buffett, but the three of those I sort of combined and blend their philosophies into something that I feel works for me and I feel could work for you, although this is not financial advice. So you can beat the market even though you're not the next Warren Buffett. Let's keep it pushing here and look at Coca-Cola FEMSA. So this is one I'm really super duper proud of. Essentially, this is Mexican Coke in a glass bottle. And so I was able to buy this stock around $1,100 of it with $260 in gains or up 32%, because I found out the same brand that Buffett bought in 1983 or whatever, I was able to buy Mexican Coke in a glass bottle, which is superior in every way to American Coke. I bought it at the same valuation as Buffett, and I was really pleased with myself. This is one that I stole from Bill Gates, who's an investing acolyte of Buffett as well, but I've done really well on KOF. And although it's run up quite a bit, I am going to let my winners win, and I'm even investing a bit more. So I have an order in on this Mexican Coke in a glass bottle. Apple's a no-brainer. One of the best balance sheets in the world. I own it individually. Buffett says this is the best single stock or investment that he's currently holding. And so I've got around $1,000. I'm up that amount. Williams Sonoma. So French cast iron skillets um, for bougie rich white ladies. So bougie rich white ladies, they drive, 60+% of consumer spending in the United States. This is a luxury consumer defensive brand. I can understand consumer brands, but I also understand that when people who have money continue to spend money, whether there's a recession or not. And so I bought it initially in some very dark times. I've been way up on it in the past, but it's come back down, and I'm adding. So I'm up 1%. I own this much. I've got another order to buy in on it here. Salesforce. This is essentially a system where companies, so 80% of Fortune 500 companies use Salesforce to keep track of their leads that they're calling to sell products or services to. And so it's a CRM, or customer relationship management software. I essentially feel that this is the Microsoft of the 21st century. It's a long hold for me. $1,000. I'm up that amount. So Intel, this is one that I had heard about from friends and family, um, people who'd been in it for a little bit, people who'd been in it for decades. Okay, um, and so this is one that I've been down on significantly in the past. But essentially, they make chips for computers. Chips for computers are the heart and brain of computers. Computers and technology are the future. They own, at this point, facilities that fabricate chips. So they don't rely on offshore places to fabricate the chips as much. They have a true believer as a CEO. They don't have the most advanced technology, but the true believer CEO is back, and he's making big, big buys into this company. And the only reason an insider buys a stock is because he thinks it's going to go up. So Best Buy, another consumer stock. I'm a consumer. I think that mom wants to go put her hands on a washer and dryer set before buying them. I think some retail businesses will stay physical, although Best Buy is doing great things with online as well. And so this is one that I did rush into. I rushed into it. I've been dollar cost averaging down on it. I've been down as much as 30%, currently down 20%, continuing to buy. I think it's undervalued. Coinbase. So Coinbase is one where I don't necessarily believe in crypto. I don't think it's been around for long enough. But when people are mining for gold, sell shovels. Or in other words, if I think that people are speculating or gambling on coins, then I'm going to own the casino, and that's Coinbase. Good compliance with the government, some very smart people with Ivy League or fintech backgrounds that run Coinbase. I've been up on it as much as 60%. I don't sell companies. So I'll probably be looking to add some more here. So we're down to Coinbase, and this is getting us through pretty much to about half of our stocks. And I'm going to stop once we get to about $300 on these. But let me just check in with the 10 lessons that I've learned and I wanted to share with you guys. So you can still beat the market even though you're not the next Warren Buffett. And so, as I mentioned, I advocate a core and portfolio satellite holding strategy, which is essentially holding a broad base ETF for half of your money and then holding about 20 stocks, individual stocks or securities with the other half of your money. And then, because I'm not good at math, as you can tell, another 5% I think should be into moonshots. So things that have either dropped really quickly in value or things that are speculative in nature, like marijuana stocks. I think you can have a small amount of your holdings in something just to scratch that itch. And so that's overall my takeaway that I would do differently. I'm going to show you how that would have worked in a second, but I want to make sure that I'm covering all these points. So the next one is going to be dollar cost averaging. And so that's another takeaway that I've learned. So when you choose an individual company, you have to be not only right about the company and its future, but you have to be right about the price you're paying for it. And so the less assumptions you make in investing, the more success that you'll have. And I guess, you know, I started investing when Trump sent me money and I was sitting around not working, thinking, collecting unemployment because my job had to end due to the pandemic. And I thought to myself, don't F this up. And so I've made $600 in the market. If I hadn't had this education that I've gotten from so many other people that I'm trying to share back with you, this $55,000 in a different part of my life would have been spent on video games and toys and on $25 trips to the gas station. And so even though I've pulled money out of the market, and I believe that this portfolio and my ever evolving strategies ultimately will make me a first generation millionaire, um, I think dollar cost averaging is really important, and it's counterintuitive. So this goes on to something else, which is that investing is both an art and a science. And so 2/3 of the time, lump sum investing gets you better returns, except for the 1/3 of the time when it doesn't. And that was the case in some of my early holdings, Smith and Wesson and Amazon, as well as Best Buy, things that I ran into at too high of a multiple. And I've had to really claw and fight and struggle my way back. So I was right on the investment, and I am right on the investment, but I wasn't right on the price. So dollar cost averaging, what I would generally say is that if you have a lump sum of money, if you don't have a lump sum of money, dollar cost averaging is always the best. But if you do have a lump sum of money, from the art and science or the psychological perspective, I think the best way to approach DCA versus lump sum investing is lump sum the first 50% and then DCA the second 50%, 25 and 25, either a month or a quarter out. And I think, in times such as these, where we have a lot of weird things going on in the market, things that are similar to stagflation or whatever, black swan, our market's proximity to the black swan event of COVID, I think going 50% in with a lump sum and then splitting off that 25 and 25 is good, if only for investor psychology. Okay. And I would have done better if I would have done that. So that's another one of my learning lessons for you. So we're going to run through these super fast. I'll get on to the rest of my takeaways from my first 2.5 years of investing into this $53,000 portfolio or whatever. And then I'm going to show you, if I was to start again today, how I would do it. And from an educational standpoint, what I might recommend from an educational standpoint. So let's look at Sam Adams. So this is another thing, you guys, is when an investment comes across your radar, it's probably because it's just recently run up a lot. So you have to be aware of that. The stock market is a forward-looking instrument. You can't necessarily look back and expect that those things will be replicated, although sometimes they can. Certain companies, power stocks like Costco, past performance doesn't indicate future results, except sometimes it does. But oftentimes when you've just heard about this hot new stock, it's because it's run up and everything reverts to the mean. And so Sam Adams did really good with Truly and Seltzer in 2021. And so I came into the company very high. I was attracted to its balance sheet, no debt, but I like beer as a consumer defensive. I'm a bit of a bear. I'm a bear who's 100% invested 100% of the time. So I do have a tilt towards defensive, but Sam Adams is, popular for Sam Adams, Boston Lager, Oktoberfest, but they also own brands like Truly, like Angry Orchard Twisted Tea and Angry Orchard Cider, as well as Twisted Tea. And so they're a low debt company, sort of a mid cap value company. Big fan of it. Around $900 into it. It's been up and down. I've been down a lot on it. Bought more shares. I'm up that amount. Trulieve. So let's talk about cannabis stocks for a second. So cannabis is illegal right now. In 2021, as I was violating rule number one, rushing into stocks that have raced up. And I'll just take a side note, my unrealized capital losses in Trulieve and Smith and Wesson, two companies that I bought at all-time highs, too much of at the same time, that erases essentially 100% of my unrealized capital losses. And the other stocks that are higher in weighting that I went into too concentrated, without those having happened, my portfolio would be up. It would be up either at, below, or over the market. And so we're learning things together here. Like and subscribe. So when it comes to Trulieve, they're a cannabis company. And in 2021, everyone thought that the administration was going to make marijuana legal, and they just, they stringed that along like a carrot, right? But I've been down as much as 80 or 90% on cannabis investments, and I'm stubborn. So it's either going to 10x or I'm going to lose all my money. And don't do as I say. Don't do as I do as I say, right? So recently, marijuana stocks have been down, as much as 80 or 90% from all-time highs, but they've rallied 80% in the last 3 weeks. Okay. And so Trulieve owns the most medical facilities in Florida, which has an aging population, and they're likely to have a ballot initiative in 24, which may or may not legalize marijuana altogether. But this is a company with a pretty decent balance sheet. And the thing that was in the news recently with the Health and Human Services recommending to the DEA to reschedule cannabis companies are at another disadvantage, which is that they can't write off expenses on their taxes. And so I just see a lot of catalysts in marijuana. And I think that as Americans, when we get rights, we don't give them up easily. And so these investments in marijuana are a 10, 20, 30-year investment that I think will 10x or more. But this is one that has sort of, hurt my unrealized gains or losses. So that's enough about that. Weed and precious metal. I poached it from a friend, looked into it. It's one of the best miners of precious metals. So we like to own assets, right? So gold or Bitcoin or any other commodity is just worth what someone will pay. But a mine that mines gold pays dividends. And so I'd rather own a gold mining company than gold, because a gold mining company is a productive asset as opposed to a commodity that just kind of sits there and you have to wait for someone else to have a feeling that it should be worth more. Whereas the company can increase dividends, or they can increase profit margin, or they can increase revenue. And so I have exposure and upside. So I own WPM. Walgreens Boots Alliance. I guess here's a second bonus is watch out for uh, super, super, super undervalued companies. A lot of the times they're undervalued for a reason. Um, I still believe in this company. I'm down on it. I'm buying more. Tesla. I bought this because of a philosophy from Dalio, which is in holding uncorrelated assets, you can have higher returns with lower risk. And so basically, Tesla is just a proxy for risk sentiment. And so they also hold Bitcoin on the balance sheet. I think Elon Musk is brilliant. I think the stock's significantly overpriced. Um, but we'll jump ahead and go to number 8, which is valuation matters mostly. And so it's significantly overpriced. I'm still up on it. So will it revert to the mean over time? Yes, but its high multiples are for a reason. The market sees a lot of success, but because it's overvalued, I don't want to have too much exposure to it. And so under $700. Turning Point Brands. So when people are mining for gold by shovels, this company owns zigzags. And so I can have exposure to a company that can get preferential or normal tax treatment, can be traded on American exchanges, but they sell zigzags. They also sell clipper lighters, which is a type of lighter that potheads like. And so I own it to sell shovels to people mining gold and to sort of offset some of the unrealized losses within my marijuana holdings. So Turning Point Brands is a cool one. Grantham Industries. One of the problems with marijuana is it's a commodity. These people have an edibles product called the Incredible Bar, which has great IP or brand value. So this is a marijuana holding. It's got about that much in it. This has been down in my portfolio, you guys, as much as 50, 60%. And with this recent rally and me dollar cost averaging into it, I'm flat and I've got a lot of shares of it. So we'll see how that turns out in 30 years. So coming here to the end of what we're going to cover, Kroger, biggest grocery store in the country, bought it during COVID. Warren Buffett owned it. CEO is smart. Vertex Pharmaceuticals. Mohnish Pabrai, who is a BFF with Warren Buffett's Lieutenant Charlie Munger, says to clone other people, be a shameless cloner. And so I looked at Kathy Wood in 2021, whose ARC portfolio went up quite a lot, but realized that 90% of her companies actually didn't produce any free cash flow. Vertex Pharmaceutical was one that did, so I stole it, and I'm up a lot on it. Not a little, I'm up a lot. I'm going to buy more of this. On pharmaceutical stocks, you have to know when their main drug's patent is going to expire and what's in the pipeline, or else you're going to freak out and sell it. So also buy what you know. And that's what I showed you earlier in sort of the sector breakdown. So I have an expectation, with COVID, with Americans living longer, but Americans having health issues. I think there's going to be a secular trend towards increase healthcare. It rises, I think, at least with inflation, if not more. And so I want exposure to healthcare, but I'm not a doctor or a nurse or, in that field. So I own the ETF. I've got a buy order in on this. Berkshire Hathaway, why not? I'm marijuana stock, Curaleaf here. Not gonna delve into it. Microsoft, I bought. I didn't own it initially. It does seem overvalued, but with them buying Activision and realizing how much money I've spent on Call of Duty, I wanted to buy it and own it, and I did, and it's done well. That's enough on that. So I think international exposure is important, and that's what we're going to see in our model portfolio here. But here's two international funds that I hold. I have a hard time analyzing companies from Canada or Switzerland or China, not only the cultural differences, but the accounting differences. I take my international exposure via ETF. That's enough about that. Um, I own banks because there's not very many skinny bankers or poor bankers. And so banks in the past have given us, 0.03% on our money. They take our money and they invest it. Banks are in the business of money. They benefit from higher interest rates and things of that nature. So I don't understand banking fully. I own the ETF. Enough said. As a bullish bear who's 100% invested, beauty or makeup, it's considered consumer defensive. And I noticed this in the last few years, be it COVID or the war in Ukraine, women will always want to look beautiful. This company, Ulta Beauty, has a great balance sheet. Consumer defensive, these people make Arm& Hammer baking soda as well as Trojan contraceptives, I believe. It's pretty expensive. I own it. I'm up on it. Church and Dwight. Estee Lauder, big makeup company. Got a lot of exposure to China. It's down. I'm buying it hand over fist. Dollar General, I think they have a moat. I think that they are the Walmart for people who live in towns of 1,200 people. I think it's a really great company. It's super on sale right now. This is one I had made money on, ran it up in the past, sold it for a realized gain. Now it's, in this particular case, it was good. I didn't hold it. It's down almost 50% in the last, from all time highs. It's not worth 50% less, guys. They're just having problems with inflation and lower income consumer feeling, the effects of the interest rate hikes. I'm going to buy more of it. So Texas Roadhouse, great balance sheet. Cloned that one from Joseph Carlson. Home Depot, owned it, made money on it, sold it. I like it long term. Great balance sheet. Aerospace and defense. It hasn't had great returns in the last 10 or 20 years, and I think the more decades I put between my life and the future, the more that major conflicts are to happen. I think that the sector is undervalued. It's also a defensive sector. I hold it in an ETF. Coors or TAP, I like it better than Bud Light. And I just so happen to be right with that weird thing that happened in the news. So that's why I own that. Starbucks, Becky's and Karen's, they control consumer spending. Utilities is a defensive sector. It's the most bond-like equity. That's why I own that. AutoZone has negative sentiment. It does well in recessions when people repair their cars versus buy new ones. Negative sentiment because of EVs, but there's still going to be AutoZones, selling windshield wipers to EVs or selling replacement parts for gasoline engines in 15 or 20 years. It's a long hold of mine I'm adding. And so that takes us down to anything that's under 300. So I'm going to just scroll down here, remind you to like, comment, and subscribe. And I'm just going to show you the rest of these holdings with the total gain on realized or losses. And you can pause and sort of review those. You can leave a comment below if you have a question about anything I've discussed or any of my individual holdings, or if you have a request for a stock review, I'd be more than happy to do that as well. So we've just given you a second to look at all these, smaller holdings that I have. And we'll do that in the last little segment here. You can pause and look at these as well. And what I've described to you about my philosophy and who I am and why I buy things and why I hold them, taking just a look at these, I think you can understand and see why it was that I had bought them. So that's that. So these are all my holdings. 65% in stocks, 35% in ETFs. And that's not what I'm recommending. So let's check back in on my 10 learning lessons. So valuation matters mostly. And then buy high quality companies is 8 and 9. So I guess one thing I'll say is, we've done this before. This is the price of a stock. and this is the value of the stock. And if you dollar cost average, you're buying at high, at below, at high of value. And so when you dollar cost average into something, eventually your average price will correspond with its fair market value. And so those are lessons 8 and 9. And so I'm going to show you guys now what I would have done with my $55,000 if I knew everything that I knew today and I'm trying to share and convey with you. So like and subscribe for this tremendous amount of value that I'm bringing you through this video. And let's take a look at what my approach would have been going back in time. So, okay, here we go. So, Buffett, this is a combination of philosophies that I've already described, but it's a combination of philosophies that are, an amalgamation of the philosophies of Buffett, Munger, less so Graham, philosophies taken from Ray Dalio, even people like Bill Gates, and then influenced by content creators like Joseph Carlson or like Jake from Dividend Growth Investing, as well as others. But this is kind of what I've come up with. And so let's see what we would have done if we could go back in a time machine with each other. So I've set up this model portfolio on Portfolio Visualizer. I went as far back as possible and then through today's date, year to date for 2023. So I took my $55,000 I've put in the market all together. And then I just split it into the last, whatever it was, 28 months or however long I've been investing. So an initial investment of $1,965, contributing dollar cost averaging in that fixed amount each month. Okay, contribution frequency would be monthly, no rebalancing. Coffee can. So this is from a Nathan W, who has a great YouTube channel. I guess I'll link a lot of these people I've referenced. I'll link their channels below. But he believes in the coffee can portfolio. Let me take a second out to explain that. So there was a couple back in the day where the wife had a financial advisor and he would tell her what to buy and when to sell and why, and or what rather. And the funny thing is the husband took the statements and just bought every time the advisor said to buy, but never sold. And his returns were higher. And so the concept is if you own a basket of 20 or 30 stocks, another great investor said you only have to be right on 4 out of 10 of them in the long term. And so, if this portfolio is a 20 stock portfolio, this is going to be our satellite portfolio. And I'll show you the core version of it as well. But the satellite portfolio, if we have 20 stocks and 8 of them do well and 3 of them go bankrupt and the rest of them do okay, you're still beating the market. And so this is why I don't believe in selling. And it's why, I believe in reinvesting dividends. But I don't necessarily believe in rebalancing either. Let the winners win. So guys, if I could do this all over today, I would start off with opening an investment probably in VT. So this is another bonus out of my 10 lessons learned is keep it simple. So VT is Vanguard's total world stock market index market cap weighted. So it's every company in the world rated by the amount of the value of the company for all their shares times the share price. So 60% of VT is US stocks, 40% of VT is international stocks. The top US stocks in VT are going to be things like Apple, Microsoft, Netflix, Nvidia, Tesla, Google, things of that nature. The top international stocks will be things like LVMH, Louis Vuitton out of France, or, different Canadian banks, also things like Alibaba, things of that nature. So it's just every stock in the world, about 7,500 stocks, that's VT. So if I could start over today, or if I was educating someone and sharing my philosophy, what I would do is I would open up a position in VT, and that is my insurance. What if I'm wrong? So I would own VT, which is every stock in the world, and I would dollar cost average into it. That would be the core of my portfolio. The satellite of my portfolio would be 20 companies, equally weighted. So I like equal weighting. There'll be another reference there. That's from Mr. Wonderful, Kevin O'Leary off Shark Tank. Never put more than 5% into a company. And you also like companies that pay dividends. I don't think that's necessary, but topic for another time. So the satellite portfolio, I'd put in money equally because I like the simplicity and I like equal weighting. That actually, I guess, is a Mohnish Pabrai investing insight is equal weighting. So guys, another rule, which is number 9, buy high quality companies. Right. So we're not Peter Lynch where we can have a team of analysts and own 1,000 stocks. We're not Warren Buffett where we can own, you know, 60% of our value in 8 stocks or in 6 stocks. Okay. And so I think you have to take human emotion out, which would be another bonus lesson, and dollar cost average in. And when you do that with very high quality companies, you're basically looking to make sure that you're investing in things that either you understand or things that won't go away over your time horizon, and companies that are high quality. That way, when you dollar cost average in, um, you're not likely to have significant drawdowns, but you have enough uncorrelated assets that when you buy into this, it's like a bicycle pedal. So specifically, I would say use M1 Finance. And when 3 or 4 of these stocks that are similar trade up, 3 or 4 of them are going to trade down. And so you always have something to buy on the dip. And so this is how we can beat the market, going back to number 5. The only way you can beat the market is to have investments that are different than the market, investments that are higher quality on average than the market, and likely fewer investments than the market. And then holding and buying at all times, especially at 52-week lows. So that's how you beat the market, and how in the long run, I believe I will too. But you're in a better position having been able to benefit from my $55,000 and my 2.5 years of research and seeing stocks go down 80% and come back up halfway in 3 weeks and things of that nature. So do go ahead and like the video, subscribe to the channel. Let's see what we would do if I could restart today. So 20 companies. So it's not unreasonable to just simply say, I understand Amazon from the consumer side. I think I understand their other segments like AWS. They're the home for the internet. And we know they're a very strong company that's had high returns in the past. And so it's not unreasonable to build a satellite portfolio that has 20 holdings, and you can just overweight to an extent, right? I'll give an example. So Salesforce CRM, it's probably 1% of the total US stock market, but in overweighting it, we may be able to outperform. For simplicity's sake, Google might be 6% of the stock market. So to an extent, it's slightly underweighted. Um, but we also understand we have exposure to it in VT. So let me just run through this, and it'll make sense. So I did a back test. It went back to 2013. Okay. And so we're going to see the results, but it's Amazon, Netflix, Google, Apple, Facebook, and Salesforce. Big tech companies, they've done great for a long time. They won't always outperform forever, but my investment horizon is 30 years or something. All these companies will be around, I believe. Some of them might turn into blue chip companies that pay dividends like Google. That'll be fine. Okay. So I just put in some companies that make sense, that are no brainers. Visa and MasterCard. They make a percentage every time someone swipes a card. Great balance sheets. Don't overthink it too much. Investing is both an art and science, Peter Lynch. Costco. I'm a consumer. I've got a little bit of a bearish sentiment. So Costco and Dollar General, consumer defensive brands, companies I can understand, way overweighted at 5% versus the market. Some individual companies that I like, even if they're cyclical, even if they're deep value, even if they're small caps, get a little bit of exposure in there. Something like Smith and Wesson and Williams Sonoma, I think those are the right investments. I still think Smith & Wesson is the right investment. I just bought too much of it at too high of a price. But when it's equal weighted and you're buying this each and every week in and out on M1 Finance, we'll see what the results would have been. Texas Roadhouse, Chipotle, those are cloned from Joseph Carlson. But Texas Roadhouse, they're always packed out. Look at their financials, they're great. Beauty, we understand beauty. If World War III happens, women are going to still want to look beautiful. Estee Lauder, Ulta. And then some exposure to things, going back to another one of my first, my second rule, buy ETFs. I am not an expert in utilities or in healthcare or in aerospace and defense or, whatever. So, but I want exposure there. So I'm going to overweight my defensive areas. When the market goes down, these will be more resilient. When the market's down and Netflix and Amazon are down, healthcare and utilities ETFs will be up. And so when these are up, I'm buying the shares that are down. But then when the market booms, these defensive sectors will go down and I'll be buying these like a bicycle. Always buy what's on sale and have a portfolio with 20 assets that are not correlated too direct with each other. And you should get higher returns with lower risk. The golden butterfly, I think, philosophy, or the perfect portfolio by Ray Dalio. These Equal Weighting Influences by Mohnish Pabrai. So I want this exposure to utilities and to healthcare because they're uncorrelated assets that are defensive. I don't understand them, so I buy the index. Same with XAR, which is aerospace and defense. I wanted a little bit more exposure to consumer defensive, so I got VDC, Vanguard's Consumer Defensive. Coca-Cola is one of the biggest weightings there. But a company like Celsius might be the new Coca-Cola in 10 years. So, while I feel comfortable with the franchise model of Costco or Dollar General that they'll be there in 20 years, I don't know if I want to be into a company like Coca-Cola that is in essence a 65-year-old person in its life cycle, right? So I did that. And so 5% on all of those, and then 100% of my core portfolio in VT. So this is what if I'm wrong and what if my individual stocks underperform dramatically. I still want to have exposure to the market. And I think you showed an international as well. Jack Bogle, have some international exposure potentially. And he flip-flopped on that a little bit, but let's look at the returns. And if I had taken the advice I've given you now, like and subscribe, where would I be at as opposed to where am I at today? So just taking these 20 companies, an amalgamation securities of individuals as well as index funds or ETFs, that portfolio from 2013 that we see here, doesn't that look pretty? So more like M1 Finance, where you can automatically buy what's low, keep the allocations the same. So this portfolio I just threw together in 3 minutes off my 2.5 years of experience, not even looking at all of the balance sheets of all the companies. I do have most of that locked in, but this portfolio I constructed with these 10 lessons that I've shared. This portfolio since 2013, it would have beat the market first and foremost. So my first portfolio would have returned 20.5% a year since 2013 versus 13.3% for the market. Okay. So it would have outperformed the market by 7 or 8%. That's huge. That's your money doubling every 3 years. Okay. And so when we look at that, let's take a look at how the portfolio of the 20 equal weighted stocks, worked. So it actually had more volatility, and you got to be able to stomach that. But look how fascinating this is. This portfolio with those 20 stocks only had a 0.82 correlation to the market because a lot of times it was higher than the market. All right. It had more volatility. Got to be able to stomach that. The way I explain this, you should be able to believe in these companies. Dollar cost average in. So it had gone down as much as 32% in 1 year, but in another year it had gone up as much as 58%. That's a lot more volatility of the market, down 18%, up 32%, a lot more volatility, but a lot higher returns. So my 20 stock portfolio returned 20.5%. The market returned 13.4%. So my 20 stock equal weighted portfolio. Okay, there's that. And then the total market index. All right, total market index. Let's see how the total market index did. So the total market index underperformed the market by a good amount because during this time, this is when U.S. tech stocks are ripped. This is 9% on the total U.S. stock, total international market, VT. The 150-year average for equity returns are 6%. Nothing wrong with 9%. This is what if your satellite portfolio blows up. Okay. And so so you just always have market participation. When we add those together, 20.5 and 9%, then the question is, how do we compare to the 13.4% of the market? So 20.5 plus 9 equals 29.5 divided by 2. So with this strategy, I would have recommended you'd have returns of about 14.8% versus 13 So 14.8% blended versus 13.4% for the market. So you're up, 1.4% a year on the market. If you know about investing, that's not a little, it's a lot. Makes your money double up a lot faster. So now what we're going to do as we wind down this video is let's go ahead and see what would have happened to my 55, to my, approximately to my $55,000. If I had started, we're going to actually try to back test this. So the beginning of 2021 was a little bit sooner. I started in about March or April of 2021, but let's just take 55. Let's see. And if you're going to log off right now, go ahead and hit like on the video and subscribe on your way out. This is probably going to be the longest video that I ever do. But how many months ago was Jan 2021? 31 months. Okay. So, and I'm going to take $55,000 divided by 31. We're going to see what I would have actually gotten as far as more money. I had followed my own future self's advice. Contribute fixed amount. So that's $55,000 divided by 31 months or whatever, which is whatever January 21 was. All the same deals. So over the shorter period of time, I'd be curious to see the results. So over the shorter period of time, everything's a lot tighter, right? It's over these decades. 2013 was 20 years ago. So 2-year increments, 5-year increments, 10-year increments, 20-year increments. This is in holding good companies for long term is where you can get these good returns. But just looking back to where, I would have been, the market since the beginning of 21 has returned 15.8%. And so this is the last, one of the last little messages is time in the market beats timing the market. So, and it's funny enough, my total US market or total international fund would have done a lot better than my 20 security holding. But this is why we equal weight and it balances out things over time. And it's okay to underperform the market for 2 years. There's probably more than 2 years in those last 20 where we beat the market by 1.4%, right? When we look over a shorter period of time and returns in 2 or 3 years, that doesn't dictate a change on my philosophy. So if I had followed my own advice, I would have made 12% to the market's 15.8%. And understanding what I know now, I know that moving forward over the next 20 years, there's the chance for outperformance when you buy high quality companies, dollar cost average into them, which means you're buying them at 52-week lows. When you have diversification, but not too much. And so the way we can beat the market is by having holdings that are different than the market, holdings that are higher quality than the market, having holdings that are higher in concentration or smaller in number than the market is what we found and how we saw, my lessons learned. The difference would be is that as opposed to being down on realized gains of a few $1,000s, I would have made 12%. And over a long period of time, I think that I would have done better. And this is what I'm moving to update and high grade my portfolio to. So I'm going to get back over here to something that is visually engaging or attractive. Right here's where we're going to kind of wind it down. So here's my last lessons. So you never lose until you sell Um, you never lose in investing until you win or lose, and you don't win or lose until you sell, right? So if it wasn't for this investing journey and the education that I've received, and I'm trying to condense and share with you this value in this education, I would have squandered my money. I'm going to be a first generation millionaire. Shout out to Wall Street Trapper, right? Um, but I think that some of the rest of these takeaways are that, when looking at risk, when looking at risk, what I've done has not been the right thing, which is to hold 68 companies because I bought six at too high of a concentration all at one time. I think the answer is to get broad-based exposure in a core portfolio to something like VT, or maybe one or two other index funds mixed together like VOO and SCHD, whatever. Have that broad-based exposure where you're constantly dollar cost averaging in, but understand that you're not Warren Buffett, but you can still, Peter Lynch, hold individual companies that you believe in and and you understand at higher concentrations in the market. Not too many holdings, 20 or 30 holdings, um, and you can beat the market in that way. And so ultimately, risk is not determined by the number of holdings that you have. An ode to Joseph Carlson: if you own 20 companies and they're all medium-sized regional banks, you have the same risk. And so in looking at the portfolio that I put together with 20 companies, my based on sort of my thesis, okay, we're going to take a second. We saw how different that was than the market. So we're going to take a look at the correlations between my companies and just understand that having equities with different correlations, that's how you reduce risk, not necessarily by holding 100 or 1,000 different companies. Okay. And so this is where we'll learn more. Let's go to assets. No, drawdowns. No, monthly returns. Annual returns. Metrics. I'm going to have to take a nap after this. All right, exposures. Summary. So basically, we're going to be able to see, when I can find it, all these different companies that I have, what are their correlations to each other, right? Just got to find where that is. Because that was the last little bonus lesson I wanted to share with you guys is, what is risk? It's not necessarily something you can avoid by having 68 holdings. A lot of my holdings are going to, sort of have some of that crossover there. But the question is, these holdings that we have, how do they correlate to each other? Here we go. All right. We've reached the end of our journey for just now. Make sure to like, comment, and subscribe on the video. If there's anything you want me to take a look at as far as the stock, let me know. But let me show you why this model portfolio, over 20 years significantly outperformed the market. What I would say is start with your core and satellite. Go 50-50 or even more into your index fund as you're gaining these confidence. Until you can come up with 20 companies that you feel comfortable sitting on for 20 or 30 years, then just start with just the index fund. There's never a rush to get into the market, except for the fact you always need to be exposed to the market. So buy your index fund. And then once you get to a point of competency where you feel like you can put together a portfolio of 10 or 15 or 20, and I would really recommend 20, I think, is a sweet spot, or 30 companies that have uncorrelated assets that have an uncorrelated exposure to each other. Until you can do that, don't feel like you need to rush into companies. So we're going to look at Amazon and we're going to see how all the other companies in this portfolio that returned 19.5% it did it because you were buying things when one was higher, you were buying the ones that are lower. So let's look at this and see, this is the actual secret of beating the market. 20 companies, uncorrelated, high quality, long-term holds, buying at all times, and especially buying 52-week lows. So the correlation between Netflix's correlation with the Amazon is 0.5%, Google 0.64%, Apple half a percent, 0.51. So this means how do these companies move in relation with stock price with the other? So if you hold Amazon and Facebook, they only move together 0.3 or 0.39 is their correlation. So 39% of the time they're moving together. Correlations between Amazon and Salesforce, 55, Visa, 47, MasterCard, 45, Costco, 50, DG, 9. That's money. Smith & Wesson, 2.8, WSM, 3.2. This is in-person retail discretionary. This is online retail discretionary. We can see why they move different. 2.6, 4.5, 2.3, 2.5, 1.7 between utilities and Amazon. Only 17% of the time they're moving in that same direction. Utilities, the most bond-like equity you can hold. And if you're around my age and you ask my personal opinion from an educational standpoint, not financial advice, I'm not owning bonds, but I will own utilities that move and act like bonds, just for a little bit of steadiness. 0.49, 0.36, 0.31, 0.58. And so this total portfolio's correlation to the market, this is how we take the market and turn it into a money printing machine. So this is not financial advice. I hope that you've enjoyed this presentation. If you have any thoughts or questions about anything that I've shared, leave them in the comments section below. Like the video. If you appreciate the knowledge and value, make sure to subscribe to the channel and turn bell post notifications on. Moving forward, we're going to be doing an update on the review of the performance of my investment portfolio, maybe every week or every month. But the next couple of videos you're going to see are sort of valuations on individual stocks. So if you have one you want me to take a look at, post that below, and I'll catch you on the next one. Thanks so much.